Okay, well, so far we've talked about angles and momentum and the secret angle and some support and resistance areas. But now we want to know is how do we know when there actually is a reversal of trend, either when the market tops out and reverses or goes down and reverses. So let's get back to our basic, simple bar chart. And remember that the bull market is caused by the big institutions. Institutions will frequently buy 10 million shares of a stock, maybe even 100 million shares of a stock. And depending on its liquidity, it could take several weeks to 8 or 9 months to get a position done. And so the big institutions don't just buy at the market, they buy on the bid side of the market, often with limits. So they're down here at the bid side of the market, and this is what creates the bull market pattern of the higher bottoms. It's competitive bidding. When somebody's there for a couple days and the bar comes down and does not take their order, other people jump in front and they start to move their orders up. But there will come a time, it's identified by the high bar, where these big institutions who are bidding, and maybe the little small fry jump in on a recommendation and drive it higher. But as it comes down, at some point, they will exhaust this bid and the last guy with his last 5 million shares is filled, and then the market will come down. Where this takes place usually is at the horizontal level of what we call the low of the high bar. We identify the highest bar of the move, we identify the low on that day, and then we wait and see when that's violated. Sometimes you'll have inside days. An inside bar is a bar that neither breaks below this low or breaks above this high, and maybe 2, 3, 4 of them quietly here, because the insiders know there's still a big bidder, but it's not really going up. But when it comes down, it indicates this guy is filled, and then the sellers appear again and you go down. On the buy side, it's the same thing. The institutions are selling. They're selling at the top of the bar, lower highs, lower lows. They get maybe to a big plunging bar, and they decide they're not going any lower. It's ridiculous to sell at the bottom, and they'll have a limit order here. And then likewise, it won't push it any lower. You may be on the side for 2, 3, 4 days. Sometimes you may be 3 weeks on the side, a long ways from the big plunging low, which the traders are focused on. But what you have to focus is the high of the low bar, because maybe this guy is just sitting there with a 10 million share limit order. And so as the bars bounce around in here quietly, the people in the know that this guy is out there. You and I don't. And we see it looks quiet, there's no volume, there's no sign of a seller, but invisibly, he's out there. When he's gone, the prices will go up through this level. And so when you exceed the high of the low bar, you generate a buy signal. So these very simple little buy and sell signals occur all the time. We can see them. There's a little downtrend here. We've identified the low of the move. This is the high of that low day. And so as soon as it gets above it, you get a buy signal. If you were going on up, we've identified the high of the move. This is the low. Once you break under this low, you get a sell signal. And we can see that just taking mechanically the low of the high bar or the high of the low bar, we get these little pivots. But we want to discriminate. We don't just want to take these willy-nilly. Otherwise, we're going to end up in periods like this where we can get chopped to death. We can find our low bar, and it exceeds it, but it barely exceeds it, and it droops on down the next day. And then maybe it breaks out, but maybe it falls right back down again. So a lot of times in looking for the acceleration out of one of these bars, you want to see momentum. If you can see one of these big range bars where there's an opening here and a close here, this is the ideal time to trade. A signal reversal bar with a momentum with a wide range between open and close. On the downside too, the first time you see the big bar with the wide range, which is coming under the low of the high bar, you want to take it. Over here, the high bar, big range, breaking under that, take this one. There'll be lots of follow through. Sometimes you get little trades like this just mechanically. They're good for 2 or 3 days. And of course, on a stock here, it might be $3 or $4. But you still will often get periods like this where you can be very choppy. Maybe the big bar low is too big a bar, and it just creates a trading range for a while. In a case like that, I often wait for a basing pattern like this to complete, and then look at one of the very last bars that define that range. And when that little top of the last couple bars is exceeded, I assume this is not just a bar, but maybe this is the next larger time frame, like it might be a weekly chart where there might be 5 individual days, and the weekly chart bar would be just one bar that was a week. So that way we'll discriminate a little bit. But there's also other ways of finding out when to expect reversals to be able to take these bars and have better percentages. And the easiest and best way is to do what we call the measured move. Now, I've said before, and I'll always say it again, the stocks never do anything that they haven't done before. They just look like it's different. It's never different this time. Once in a while, you'll get a trade every 10 or 20 years that is different than you've seen in 4 or 5 years. But in relevance, if you look at 100 years of data, you'll find the same type of things occur every 20 years. So you first of all want to go back at least a year or 3 years or 10 years if you can with your data and find out what these big moves are. So in a cursory examination, we take a low to a high, and we just copy this original vector, put it over here at the next low. We find out it's about the same. We copy it again at this low. We find out it's about the same. Copy it at this low. Went a little higher in this case, but in terms of time, the time duration was about the same low to high. And this is the same low. And as we talked before about angles, we see why this is the case. This is the movement of the uptrend, and it's superimposed a little downtrend. So this little thing doesn't really count. That's why we drag our uptrend bar over again until the downtrend cycle is done. Then we resume our uptrend again. It goes about the same, superimposed with a low downtrend. When the downtrend is over, we do our original uptrend. So these measured moves are going to help time us when we're going to look for the signal reversal bar to sell out or go short. So for instance, if you had a little signal reversal bar here with all this chop, we might not take it because an original measured move might say it's going to go a lot higher. So we would like to see almost a full measured move, at least within 3/4 to 7/8 of that distance, before we expect the trend is done. Now, I rarely use moving averages, but one way with the computer you could use a moving average would be to identify measured moves over long periods of time. You could take, for instance, a 50-day moving average or a 50-bar moving average and have the computer tell you what was the greatest elongation above that average. Perhaps you did a 1-day moving average and a 50-day moving average and found out what percentage the one was above the 50, and that would tell you the greatest amount that had ever occurred. This is due to the fact that cycles are a bunch up. If you had a 5-day cycle, a 7-day cycle, a 12-day cycle, a 20-day cycle, at some point, all of them will come to a common denominator and they will all bunch up. And these are usually these big parabolic runs we see. And at the end of the parabolic, all of the cycles have come together and they've created the biggest elongation above a moving average. If you're using a long-term chart, you can try it with a 200-day moving average over like 5 or 10 years. Because within 5 or 10 years, almost every known cycle of 2 months or 3 months or 9 months or a year and a half, all of those are going to repeat and have a chance to bunch up. You may not find a cycle that's 50 years in length, but you'll find all the shorter term ones. And so that particular measured move will be good. We also find out a corollary here is that the measured moves go in any direction. So if we find out how much above it is, that also can be a high to a low to a high, and we can measure these time periods sideways. Below the moving average, they measure down below it too. Sometimes when they exceed it, they will go 1.5 times or 2 times it. But these are just a general rule of thumb measurements. The easiest way to do it on your charts, and here's a S&P, when you have an initial impulse wave, you just draw a line from low to high, and you copy it. And then after the intervening short-term cycle hits, you drag it over to the next low and put that on. Now we noticed here, this one topped out at the midpoint of the measured move and went down. But the low here was still a higher bottom. So we know the overall uptrend is still in force. So this measured move will ultimately be realized right here. So we keep track of it this way. But I also often subdivide these things and put a little marker at the 50% level where they might pivot on me. Same thing happens here. Same measured move. It topped out at the midpoint. measure it here. This one did reach its objective over here. This one over here met its objective over here. So they are very precise. They always do the same thing. They just look like they're doing something else, but this top is a measured move from there. This bottom does create a top here. This top here is from here. So this is what I mean by measured moves and looking for places where we might find our reversals. Here's another example. Once we find our first measured move, we copy this. From every low, we copy it. This one, it looked like it broke a little early, but it was still making higher bottoms. So the objective was not fulfilled. It zooms up to the objective and then goes down. Again, over here, it only went to like 50% of this, and then spent a time basing in here, still making a series of higher bottoms at the same level until it fulfilled the objective. Then it corrected again. Then it went up to the objective. Then it corrected again. And note, on the way down, if you're in an uptrend, of course, the correction down has to be smaller than the leg up. Otherwise, you wouldn't be in an uptrend. And usually the uptrend is steeper and the decline is less sharp. But it's a combination. They can gradually go down a certain amount, or they can plunge dramatically and move sideways. But they'll usually reach the same measured amounts. So I will duplicate the first correction and make these parallels. And then when we get to the bottom of the parallel, this is the point I would be looking for my entry point if I was going back long. Sometimes they do it very fast and they break under it. Now this might be a case of what we call overbalancing. The first time you start seeing overbalancing, where the declines are bigger than the previous declines, this is a sign of a change in trend. It means the underlying cycle has changed and it's not so strong, and the short downward cycles are gaining the upper hand, and you're probably now going to go into a series of lower highs and lower lows, and you can probably start thinking about shorting this. But it needs more work to be decisive on that particular pattern. We can also put some numbers on our retracements, and we find out that often it's a quarter, a half, 3/4, or they're Fibonacci numbers, 382618. We can use our measured moves. We can use square roots and square root increments, and we can also use what I prefer, the Jenkins natural ratio levels. So these are all methods of making an approximate guess of where it's going to correct and where we want to reposition ourselves on a new long if we've sold out. Here's a typical advance. When it corrects, it usually overshoots the 50% correction a little to a 382, bounces around. And the whole Fibonacci thing comes basically from this observed pattern that they usually gravitate around the 50% retracement, give or take this 11.8%. 11.8% above 50 or 11.8% below are the Fibonacci ratios, and those approximate where you're going to go to. If you had a big run like this, you would expect a correction approximately to the 50% level. But I have here this 0.382 and the 618 Fibonacci levels, and we can see that it does bounce around in those. I would also note that we basically want to be invested long, if we're a long-term trader, during the swing part and not during the correction phase. When you're in a down or correction phase and you're at your 50%, this is no place to really be invested. You can get chopped up quite a bit. You do, if you're going to be a long-term holder, you can buy with a stop in here. But ideally, as a trader, we want this period to be done. And as we start to break out again above this little parallel base in here, as we start to break out, this is where, as a swing trader, you'd be going long again and sitting tight for the next big move. That would probably be the same measured move as the first distance up. So this is a percentage correction. We also can have a angle correction. This is with a speed resistance line. From the high to the low, we can divide it into a half, and we see there's an angle here, an angle of 50% that's catching it. The horizontal of the 50% going across horizontally is this horizontal level, but the actual angle is climbing, and so is the 0.382 and 618. So these are growth rates of the angle retracements. Other type of angles can be offset angle corrections. You measure a angle of a prior decline, and then offset to that angle you put on your angles. What I used to do is